Good evening, everybody. This is November 23rd. It is just about 7 p.m. here on the East Coast. And this is Jeff Scott, and welcome to this week's weekend review. I also want to take a quick opportunity to wish everybody a healthy and happy and safe Thanksgiving holiday. At the Scott House, we're recently back from Australia and eagerly awaiting the return of our favorite child, our dog Boone, who'll be coming home for Thanksgiving as he's been staying with my daughter in Nashville. I titled today Year-End Melt-Up. Maybe that's wishful thinking. It's certainly been some vicious sector rotation, and I think last week, as I'll demonstrate, showed a little bit of junk off the bottom. But we are getting into a period of time when we might expect a market rally. We've already had 12% since this last low, so I guess if we do rally, it will feel, we will be getting to some stretched areas. Go ahead and start the show. Disclaimer, this is for education purposes only. Any recommendations are in the spirit of education, not investment advice. Remember, I'm a doctor, not a broker, and I am independent and not affiliated with any software vendors or trading companies. Any tools that I demonstrate are those that I use in my daily trading, and I have paid for everything just as you have. Now, I wanted to add one here, which I forgot to add today, but my whole style of teaching, training, trading is to be your own guru. I didn't go to any formal training, although I've spent a lot of time going to various investment seminars and reading books. And I've developed a style that fits me. I don't expect that my style should fit you, but I hope that I can give you the stimulus for you to go and develop your own style. And if I can help you, then that's great. Much and all of what I do is based upon what I learned from William O'Neill, How to Make Money in Stocks, his disciples, Morales and Katcher, and as interpreted by Ian Woodward and Ron Brown, who took HGSI, the software, developed HGSI, the trading philosophy, which I believe improves upon what O'Neill taught us. Others that I find very valuable: Alexander Elder, John Person, great trader and teacher and good friend; Van Tharp in money management; Stephen Bigelow in candlestick formation; and my trading buddy and education partner, George Lea, who I had a great time with in Vegas, as well as Chris White and many others. Other books are up here that I've read. The one that I meant to add might seem a little strange, but it's called Point and Figure Charting, and it's by Tom Dorsey, and it really is a fabulous book. And like us in HGSI philosophy, it's a top-down investing approach, and he shows how he uses point and figure charting, which is quite simple actually, and how he uses it as a top-down investor, and he puts a lot of merit on sector rotation. And where he goes perhaps beyond what I can do in HGSI is he also looks at other instrument classes, whether it's international versus domestic, currencies and metals, and other futures versus stocks, and looks at relative strength of the various instruments to determine where he should be putting his money. I blanked my desktop so I don't have to explain why I have 4,000 computer programs for trading. What I really need are the ones that I've listed here: Tradestation, Thinkorswim, and Genesis. And for analytics, I use HGSI and EdgeRater, balance it out with multiple seasonality programs, Best Choice, Magentatrader, TradeMiner, and even within EdgeRater. Kudos to Derek at Magenta. I'll show you a couple of pictures of what he's added that I think makes just a significant difference in a recent update. And then I use MarketSmith to do a lot of my some scanning and a lot of backing up some of the HGSI work I do, some increased fundamentals that it might offer, as well as their pattern recognition. Speaking of pattern recognition, we've spent most of this year kind of at this shoulder where I get on and I talk about we've had a big run. At some point, it'll be time for a pause and a pullback. And we've had multiple fairly vicious pullbacks. The last one ending about a month ago. And as we've come off the bottom, each time we've had nice recoveries. And this one, as I said, is up about 12%. So it's getting long in the tooth. But even though I say that, even though I think the risk is getting higher of a significant pullback, I can't start shorting things just because we're overdue. And I'm going to trade the market I get, not what I think we should have. But we are at a point where we've had a nice run. Just to remind everybody, we're starting to fill up. And I tried to design this meeting to be, the cost of the meeting is probably comparable to the other meetings I've done, but the cost of attending the hotel's a little bit cheaper considering we're in season. But it's the best of George Lea and HGSI Doc. Hopefully I'll have some of my local friends who I won't name here in case they say no, speak, who spoke in June. February 7th through 9th, Best Western Windsor Gardens Executive Center. Email me for more information. Basically, meeting will be Saturday, Sunday, and Monday with breakfast and lunch provided each day. I've set up a cocktail reception in the conference center on Saturday night for an hour or so after we finish. Dinner reception at my condo on Sunday. Each attendee will get a screen capture video of each presentation, all PowerPoints in Adobe format, and any customized views will be shared only with the attendees. I will offer my Tradestation indicator package, which I don't routinely offer at this price, at $250 for anybody that wants it who is an attendee. Key, you have to attend my live meeting to purchase at this price or have attended one of the previous, and the price is $800. Please reach out to me. I can expand the room if I need to. I just need to get an idea of how many people are coming. Those of you that reached out to me before the official announcement, it's time to commit. And I'm going to start to do somewhat like airline seating, and we will let people choose seats based upon their the date of their registration. I just want to do a call out to Derek. I'll probably show you this in real time, but many of us have been asking Derek to implement a calendar function within Magentatrader. And so those who don't know Magenta is one of the premier seasonality packages in the market. Many of us started with Best Choice. Magenta offers a more modern interface, but Best Choice still had a calendar function where you could get your list of stocks that met your requirements for trading and run them throughout the year and find out when was the best time to trade them. And Magenta has now built in a calendar function where you can add in whether you want to look what month, you want to look shorts and longs, how many years you need to have data for, winning percentage, and the change, how much you're looking for return. And it prints you out a nice calendar where you can, I'll show you how you can click on them to see what it looks like. But very exciting, and thanks to Derek for doing that. Always we need to know what's to occur in news and earnings. We are in the midst of a holiday week, so one might expect something big to happen from volume, at least activity on Monday, not necessarily movement, maybe Tuesday, but I would expect late Tuesday and Wednesday to be quiet and the market closed on Thursday. For those who have also interest on the economic releases, you could see that there are some that probably at some point in life would be important. GDP's probably not a lot of surprises are expected. Housing index, housing had some good numbers this past week. This is seasonally a good time for home builders, as we'll see. And claims and continuing claims will be out, as well as a number of other things, Michigan sentiment. But this is a second reading or third reading of that number, so one would think that this is already in the market. Be aware of if you got earnings, there's some technology earnings coming out on Monday after the close that some of you or I may have interest in, especially when you look at things like Nuance, Palo Alto Networks, and Kihu, Workaday, that fit the mold of HGSI stocks. All right, so let's go take a look at the market. We'll start with the market that was, and then try and get an idea of where the market that is going. Let me open up my Excel spreadsheet. All right, so for those that are newbies, one of the first things that I like to do is look back and get an idea of what worked last week, and with the assumption or maybe I should use the word presumption, of what worked last week might give me an idea of what's working this week. Now in HGSI, I create multiple lists, watch lists during the week. And this is the watch list that I started this weekend. And these are groups that I've been following over the years. They include some of the smart groups, which are done for me. It includes a group inclusion filter, which takes the best of the best from multiple groups. It includes some scans that I do in Metastock. And I filtered through a lot of different things over the years to find the ones that I felt were most valuable, like this long blue sky breakout. It also includes, I got a size adjustment here, hold on, a number of things that I do in Tradestation. And I find all of these complementary, although I guess at some point they become somewhat duplicative, but you could see a number of different Tradestation scans that I do. I'm always curious as to which are the ones that were working or are working, and perhaps I might be able to fine-tune my trading or get an idea of what's working by looking at this. Within HGSI, there is a thing called a group performance analysis, and I can take all my groups, any groups I want, and I could pick my dates. So I'll look for the end of the day, the prior Friday, to the end of the day this week, and let's see what the performance was. Now, what I learned from this is, make sure that my portfolio is at least holding its own. But more importantly, I look at the HGS 100 and the IBD 50 and the MarketSmith 250 so that I get a feel of where growth stocks are compared to the market. Sometimes you'll see that we overperform, sometimes we underperform, but I always learn. So what did we learn this week? Well, the first thing is that the market was up 1.16% if you look at the S&P 500. Now, I think the S&P 500 is more important to me than the Dow Jones 30 stocks, but I trade a lot of small stocks, so it's helpful, but it gives me a metric, a bar in the sand. Now, it turns out that the stocks that I owned at the end of the week Friday, which were quite a few, because I load up when I'm bullish or more bullish, they were up about the same for the week, so I'm pretty happy. Now, what was interesting is when I look at the stocks that I had put my buy watch on last week, and just because I put a buy watch on doesn't mean I buy them, they were actually down for the week, down about a third, although I had more that were positive than were negative. Now, if I look at the IBD 85.85, the IBD New America, they were both down a teeny weeny bit. The HGS 100 was up 0.21, and the IBD 50 was up 0.4. So pretty clearly, growth stocks, HGSI type stocks, IBD type stocks underperformed the market this week, although not by a horrible amount. What's interesting is if I look at what's on the bottom for the week, the stocks that had Bible gap ups on Friday were actually down 6%, but there was only one that met my criteria. My top stocks the week before were down 5%. Breakouts were down 2.86%. My Tradestation Bible gap ups from Friday were down 2.6. You just go through the various growth stocks, young guns, best stocks under 15, demand groups, squeezes. All my great groups underperformed this week. So this was not a week for growth stocks and leaders. It was a week for what was at the top. Stocks and groups moving to the downside was up 3.47%. I'm not talking about up if I shorted them. That's up if you went long. Green candle lows, which could have been a reversal sign, were up 3.22. Blue side breakdowns were up 2.6. Negative earnings growth were up 2.55. Potential short sale stocks from HGSI were up 2.34. Groups and stocks to the downside, small ones, were up 2.32. The point to me is simple. Even though the indexes were up a little bit for the week, many of you and me at one point during the week felt some pain in our portfolio because there was fairly vicious rotation out of leaders into laggards. We'll see if that continues this week or if that was just some window dressing. I can also look from the opening day Monday to Friday, and when you start the week with a big gap, you could make an argument that I couldn't have bought those groups at the same price they closed on Friday. That wasn't the case this week. I look at the Hindi. I introduced this at my meeting a couple weeks ago, and just to explain it one more time, the Hindenburg is a old analytic story that looks at four things. It looks at new highs and new lows on the NYSE being above 2.2%. It looks at a rising moving average, 50-day moving average of the NYSE. It looks at a McClellan less than 0. It looks at new highs less than 2 times the new lows. And if all four of these hit, you get a Hindenburg omen. Now, I'm going to have to ask Chris about the moving average because I'm not sure that that's functioning correctly. But you have to have the other three for that to matter. And as you could see, we've got 6% new highs, but very few new lows on Friday. You can see a number of new highs and new lows out of 3,252 stocks. I updated my list, so I eliminate some things that were no longer trading. The advancers and decliners, 2-to-1 advancers and decliners. So you don't see, there's no Hindenburg signal. Now, those who don't know what a Hindenburg is, it's very simple. A Hindenburg is a signal that has fired prior to all major corrections over the last 30 or 40 years. It usually fires several times. There has not been a correction that hasn't been preceded by at least a single Hindenburg. And however, 3 out of 4 Hindenburgs, especially when they occur by themselves, do not lead to a change. So no Hindi makes me feel good that we don't have an imminent major correction. Doesn't mean we couldn't have a 10 or 12% pullback. I look at the bucketology at the S&P 1500, and I look at these 1,500 stocks. I put Bollinger Bands on them, and I want to know how many are above the midline, the 50% point. 2/3 are, which is a healthy number. And then I want to look here to see where the stocks are grouping up. And I see that most of them are between 70 and 90 percentile, so getting towards the top of the Bollinger Bands, but not at the top. Why is this important? Because in a bull market, stocks will bounce between the 50 and the 100% mark, and in a bear market between 0 and 50%. In a very overbought market, we might expect to see a high number of stocks in the group that's above the top Bollinger Band, and in a market that is way oversold, we'd start to see them accumulate in this bucket. This is a picture from EdgeRater. Also in EdgeRater, you can really look at the wax and wane of the market and see and try and find where we got to peaks and valleys. I'm not sure you could see this, but you can see on November 3rd we hit 90%, and we've come off a little bit since then down to 67%, and that was probably the peak. As I've seen in this bull market, when we get up above 90% of stocks trading above the midline, or we get a large number above the upper band, stocks seem to go sideways more than they fall. On the other hand, if I go back to, say, October 1st and 2nd, that's when we hit the lows of the market, when we had 90 and 88% of stocks below the midline on the S&P 500 on the Bollinger Bands. And during this bull run, that has been a signal of impending market recovery, and basically that's what we've seen here. So I see all clear here, nothing to be concerned either way. I look at the Woody indicator on the markets. Not going to spend much time explaining it. These will be some of the topics for our meeting in February, because I do think that this provides some value. And basically, what we're looking at are, in this fourth column, green is when it's okay for me to be long, red is okay for me to be short, and when it's going in and out of colors like it was here, or this period of time here, this is chop and painful to trade. And as you can see, this year we've had a lot of chop, although we've been in a continuous bull market. since, or bull run rather, for about a month, as I mentioned earlier. The yellow that came in here are the small stocks, and there's no question that this week the small stocks demonstrated a little bit of weakness. Then I could look and show you my setups for George Lea, Morales, and Catcher. And these are really great because if you're looking for tools that can shorten your analysis time, if you run this in EdgeRater, you can just look at the stocks that had 4 blue signals. And there's quite a few of them this week, but these represent some of the strongest stocks in the market. And it's just a great way of reducing the amount of time that you may spend in doing your analysis. I am somewhat crazy, and I like to look at 600 charts on the weekend, which I've done. I'm closer to 800 this weekend. But during the week, I rely on my scans to give me a much smaller amount. I like to look at seasonality in many different ways. And if I run the my trading universe, which is stock price and volume driven, there's about 3,000 stocks. And if I run them, I can see there are a number of stocks, as you can see here, that over the next month have been up 12 out of 12 or 11 out of 12 years. I point out some of the steel plays as being interesting. I can also rank it by return. So, for example, I don't currently own MSCI. I have no idea where the stock is, but I can see that over 10 years, it's up 9 out of 10 times in the next month for an average of 33%. Genworth Capital is up 10 out of 10, 29%. Here's AK Steel, 23%. Here's Lennar, 21%. Now, if a stock has been up 10 years in a row or 9 out of 10, and it's averaged a return of 33%, those are much better odds than I got when I was in Vegas. And I use this as a tool to help me identify stocks that I might want to be looking at. Now, I can also look at ETFs, and I can see that over the last 20 years, 17% of the time, so I think if I do the math, that's 85%, the S&P 500 and the spiders have been up an average of 1 to 2%. That's a bullish time of year, not the time of year you would expect a major sell-off. Healthcare up 2%, 13 out of 15 years. If I come over to the side on the right, I've ranked them by return, and I made a comment that that home builders have a good run coming 8 out of 8 years up on the spider for home builders, an average of 9% over the next month. Now, you tell me, do you want to be in home builders? Or at least by the spider? No guarantee that past performance will predict the future, but when I see 8 out of 8 and a 9% return, when I see 17 out of 20, clearly this is a bullish time of year. All right, shut this down. Next thing I do in my own analysis is I do a very quick look at the Elder impulse indicator. And, Alexander Elder, he's just updated his book. Brilliant guy. Has given us indicators such as force index that we use. I look at this view here, specifically looking at two things. I'm looking at the color of my paint bar. This is in Tradestation, and I guess you don't really need to see my stuff. I'll make this bigger. Yes, I'm up, so I'm a happy camper. You could see blue and green on paint bars. You see these red dots here. These are MACD divergence bars. And what I see I'll start at the top. Let's go to the index. The NASDAQ, blue bars at the top of its envelope. This blue says it would be, it's not really a neutral signal, but when it's green, Alex would say something like, to paraphrase him, the buying window is open and it's okay for him to be long or hold. When it's or short, excuse me, you back up it. When it's green, I think I may have said that anyways. When it's green, the buying window is open and it is okay for you to be long or to hold. When the bars are red, the selling window is open and it's okay to be short or to hold. And when it's blue, it's neutral. You could be long, short, or just hold. So I don't like to go long when these bars are red, and I don't like to go short when they're green. When they're blue, I have an option. So what do I see here? I see blue on the NASDAQ. I see green on the weekly and green on the monthly. So I think the NASDAQ is available for buying, NASDAQ stocks. But this red dot here is a little concerning because it shows that we're having MACD divergence, at least on the weekly. And let's just blow up this chart. And you could see that we've hit a new high here. Okay? But if I look at my MACD over a period of time, let me get my MACD is going down while my price is going up. So that's a true divergence, and that's why this red light light's up there. Now that doesn't mean it needs to sell off, but it's evidence that this market is getting into territory at risk of a sell-off. And you could see back here the MACD divergence persisted for almost 2-3 months before we had our sell-off. So NASDAQ looks pretty good. What about the Dow? Blue, green, green, nothing else to add. MACD divergences at play on the weekly. What about the Russell? Not so pretty. Blue, green, blue, that's not the problem. There's no divergences. And in fact, you could see down here on the daily, we actually had MACD positive divergences. No, John Person, I think, is correct. He calls it convergence. Regardless, the signal works at the top and in the bottom. But the bars are blue. I don't like this sell-off that occurred on Friday, sort of a shooting star looking candle, and that might be worrisome. Bottom line is, though, it's blue, and I can really have that option. If I go to the big stocks, the S&P, blue, green, green with the MACD divergence at risk in place. This isn't hocus pocus. I don't really want to give you the formulas of how you calculate this. I think you can get them easily from his book. I use this as a filter on stocks. I use this as a filter on what the market is doing. And I find it to be quite valuable. Just to finish up, NASDAQ 100, or the S&P 100, blue, green, green, and the NASDAQ 100, also blue, green, green with the MACD divergences. So enough of this for a while. Let's jump into HGSI. So when I look at HGSI, there's a number of things that I want to do now. I want to get a sense of how the market is doing and what's leading. Stocks versus the dollar and volatility. Gold and silver versus stocks and versus the dollar. Big stocks versus little stocks. So I start with my warehouse view showing me all securities, of which there's 8,197 in the market right now. Then I go down here to Woodward and Brown user groups, and I open up Major Markets Plus. And then I want to change my view to top down. All right. Now the reason why I want top down is because it's all technical, it's all price and volume mediated, and it's heavily weighted towards Friday, some weight towards the last 5 days, and less so 3 weeks. But it's all technical. I rank it by raw combo, and it tells me using those criteria that NYSE, Dow, mid caps all up the top. Interestingly, the NASDAQ 100, S&P 100, and Russell 2000 are on the bottom. Dollar's in the middle, and volatility is totally on the bottom. So big stocks, or bigger stocks, in the Dow doing better than little stocks in the Russell. If I look at 5-day performance just for the kicks of it, semis up 2.7, small stocks are negative, whether you look at the Russell or small caps. If I look at 1-day performance, small caps were up 0.1%. Nothing negative on Friday was volatility. So that basically gives me a little bit of information. Now let's take a quick look at the major charts. And again, I have to resize everything because if I record this at my 3K resolution, 1, you won't be able to see it. 2, it'll take up a zillion gigs of hard drive space. And 3, forget downloading, it'll take you too long. So first thing I do is I leave my usual nuclear scan with on-balance volume view up, which really doesn't help me because there's no volume, so I have no force. So this is going to be white. There's no OBV. But I purely have this here to get a look of what's going on in Eurekas and Phoenixes, looking to see if we have any of these follow-through type days in the market, and we do not. So now let's go to a plain line charts. S&P 500. Is this time for another leg up? Now, it closed midway down the bar, so it's sort of a distribution in an update perhaps, as it sold off from the high of the day, as did the Russell. But it's hard for me to discount the fact that it was up 0.5%, 10 points, and it did gap up nicely, and this is on a daily chart. And again, I mentioned 12%. Where do I get that? Let's see what it is here. Not only are my charts off, they're also things that end up on the wrong page. So let's just draw a trend line from the bottom here, which was 10.15, to the close on Friday. And you have 13.2%. That's a pretty big run. Now, one could also see that the we were slowing down, and then we popped on Friday. So will we go up in a melt up? Remains to be seen, but one would expect a bullish week considering the holiday and time of year. That's the S&P 500. The Dow, similar pattern, big up day on Friday, and from the intraday low, let me put this back up. Not perfectly drawn, but 12%. Let's look at the NASDAQ. You can see a big red candle on the NASDAQ, but it's not a down day because the NASDAQ gapped up quite a bit and still closed up 0.25% or 11 points. The NASDAQ is up 14.4% in 27 trading days since that mid-October low. Russell 2000, so the NASDAQ, the S&P, and the Dow, not only are they up 12 or 13%, they have pretty much all closed at a recent or all-time high on everything but the NASDAQ. The Russell, not so nice. The Russell 2000 had a big day on Thursday, gapped up on Friday. Like the NASDAQ, it closed in the bottom of the range. It was up 0 on Friday. It was, let me make sure I got the right thing here. It was up 0.14%. And on this run, it's now up 12.6%. But as you could see, it did not reach its highs. It hasn't met its July highs. And we're kind of at a point now where we're pretty close to failing at the September highs. Now, failing is a big word. This could just be what it takes before we get another leg up. But the laggard is clearly the Russell 2000. The dollar has been very strong in this run, and easing everywhere else leads to strength in the US dollar. Now, at some point, even the guys that are not believers may have to believe, as we've now broken out above this trend line that I drew back to December of 2010. Now, you could argue that we're still range bound and we're going to pull back in, but this has been a very strong move, although we have a long ways to go to get back to the 2008, 9, and 10 highs. Dollar strong, you can predict what's happening to gold, and although it seems to get an occasional little bounce, as we saw the last 10 days or so, there's a lot of overhead supply, and it looks like we had an ice hole failure here, failing at the 50-day moving average. And as taught to us by David Elliott, I would not be surprised to see the dollar pull back down. That said, the dollar has shown some strength here. When I look at seasonality, however, over the next 1 month, 30%, only 30% of the time is the dollar up, and gold up rather, and it's the average return over those 10 years is minus 2% per year. So hitting resistance at the 50, and silver not quite up to the 50. Lots of weakness. Lastly, the VIX. The VIX is down, is about as low as it's been. I guess it could go a couple more points, but a quiet VIX is conducive to a good market. I don't make money easily on a rising VIX. I make a lot of money when the VIX is falling, and eventually you get to a VIX that's so low there's only one way for it to go. But for those that have been in this market for any length of time, this VIX has been trailing, and except for very short-term spikes, of which the one in October was pretty impressive, the VIX has been, this is where it likes to come to rest. Now, will it come to rest here for weeks, or is it going to turn around and go up? We are in a period of the year where one would expect to get some respite. All right, so I guess my assessment here is it wasn't a great week for growth stocks, but the market kept on chugging. So I don't see anything that says that this market has to come down, that we have an imminent correction. Be smart, recognize that 12 to 14% runs. I think I read somewhere where they said that a good year in the S&P is 12% return. We've had that in the last 30 trading days. At some point, this market will pause, but I don't know when that's going to occur. You don't know when that's going to occur, and I'm certainly not going to be shorting and increasing the amount of protection I have in insurance on my broad-based portfolio just because this has been a long run. That said, there are some areas of weakness, and maybe we'll pick them up as we do our industry review. Let's drop down to the 07 group, and you can see we have 177 industry groups. Now, I don't leave it on top-down analysis because I really don't care what's been happening over 3 weeks. Lots of things happened in the last 1 week and 1 day. So I'm going to look at the 2-day force. The first thing I notice is that we have 79 groups to the upside. So even though there was some pain, per se, in the market this week, the vast majority of the industry groups were trading up. Now, sometimes when I feel like that's changing quickly, I'll look at a 5-day group, and you could see 79 on the 5-day. So this has been fairly persistent and not just a 1-day event. To the downside, there's only 11. And just quickly looking at them, healthcare services, there's a couple of healthcare here, healthcare services, generic pharma, mortgage finance company, banks. But if you look at their 1-day down and their 5-day down, none of these have really gotten hammered. However, if we look on the upside, that's where most of the action is. So I want to talk about several of these. And although they didn't make it, let's see if they made to the 5-day down. Yeah, I want to mention airlines. Airlines look heavy here. And I have a big position in Delta. And, I don't know what's going to go on with airlines here. let me go into I certainly wouldn't be out short. Sorry about that. I wouldn't necessarily go out and short everything in this sector or even short Delta, but these stocks have had a big run. If I look at Delta, for example, from October to the close, it's up not 14%, but 42.7%. It looks like it's tired. If you're a fan of John Person, we have a low close doji that occurred on Friday. We had a PSAR reversal that occurred on Friday. I have a MOBO to the downside that occurred on Friday. And I bought some puts to protect my stock. I've got Delta in the single digits, and I've got a lot of it. And what I'll do to manage individual stock risk is when I'm concerned, I'll buy puts. Now, right now, you can buy a $45 put, so $1, kind of where that PSAR dot is, for about $2.50 for the next month. So that's what I'm in. And so stock goes up to 50. I've kept my stock, and my put goes to 0 at 4, but I don't care. My stock is at 50. Stock stays the same. My put will hold value until the last couple of days, and I may or may not still be in the put. If the stock drops to 40, I can still sell my stock for $45 a share. My break even is $42.50. Anything above $42.50, I'll lose money on the put. But by doing it, I've got insurance and protection, and it's less than an 8% stop. It's about a 5% stop. And that's how I like to play on individual stocks when I'm concerned. But Delta looks tired. Southwest, similar pattern, low close doji. Copa Holdings already was in a downtrend. American Airlines, again, is this horrible? Are they going to come crashing? I really don't think so. I think we're in a multi-year run for airline stocks. The talk that fuel may remain low for the better part of the next year, gas rather, is also supportive of good airlines pricing. The fact that every time I fly in a plane, the plane is full and ticket prices are getting more expensive are also supportive. So I'm looking at this as short-term weakness, but when I identified it last week and they started making my screen, I did get some puts on the one stock that I've got left in that holding. So let's go back and let's look at some of the leading groups. Forest 2-day up, exploration and production. This has been a beaten up group, and they've been making it to the top the last couple of weeks. Now, for newbies, I'm going to very quickly tell you what's on this chart. This is, HGSI has some fundamental information. It tells you if you click up what the company is and what group it is. You can see revenue and earnings. You can see some fundamentals here. Specifically, I looked at dividend, short interest, return on equity. A little bit more fundamentals, some of the moving averages, including volume. And so you can click through those. I usually leave it here so I could see earnings per share growth and revenue growth. When it gives a percentage here, it's not comparing to last quarter. It's comparing to the same quarter in the prior year. So then I have what I call my technical windows, the bongos and the force index, and it's the top two and the bottom two. And green is great. When I see weekly red on the bongo, I know I've been in a downtrend. When I see the short-term one go green, I know that I'm pulled back, and or in the case of a downtrend, retraced. These bottom two are the force, same thing, longer, 13-day and 2-day. In the center, I have accumulation distribution. Green is accumulating. This is my high jump bar. Included in my high jump bar is green candle lows and red candle highs. I track Bible gap ups, squeezes, and MOBOs, a 200-day moving average, a 50-day moving average, and a 17-day moving average. This dark gray thing is group index. Here I look for pocket pivots. This is on balance volume, and I look for kahunas down here. I've got about 20 minutes before I have to get off, so I'm going to try and pick it up a little bit. So EOG Resources, it's got earnings per share growth, although it looks like it's slowing down. It's sold off quite a bit. It's in the movement up. It's stalling out at the 200. It failed it here. It looks like it failed again on Friday. On balance volume is pointing north, mostly good up here in technicals. This is a leader. I wouldn't touch it though until it broke above the 200-day moving average. Apache sold off hard, going sideways. Did have a pocket pivot on Friday. Doesn't look as good here, though it had a mobile breakout. All these stocks have sold off hard, which means there's quite a bit of overhead supply above them. Pioneer Natural Resources, same picture. Again, going to have to get above this 50-day moving average, which it failed at here. Anadarko looks better than the others. It's in a short-term uptrend, had a kahuna, on balance volume went positive. Long-term bongo is red, and its distribution is only a D. It too has got to get above the moving averages. So when I look at this group, I see a group that has been beaten up and trying to come back. I looked at a number of these earlier today, and they all are about the same. If oil stabilizes and goes up, you can probably pick which one you like. Here's Marathon. Again, same pattern, sell-off going sideways, has a lot of overhead supply moving averages to get through. So they're up because they had a good movement week up and they have a lot of volume, but they're not jumping off and say, buy me. Integrated oils, interesting. So Petrobras, maybe somebody can respond on the board that something positive happened in Brazil this week, because for the first time week in a lot of weeks, I saw a lot of strength in Brazil stocks on Friday, Petrobras included. There's a lot of fleas on this stock. It's got great oil reserves, but its majority owner is the country of Brazil. There's currently some fraud investigations, and it's got huge debt. So big move off the bottom, but it's still, as I said, it's got issues from the Brazil. Exxon, like the oil exploration, you're getting up to resistance here. It did have a pocket pivot and a kahuna. On balance volume is above its moving average, had a mobile breakout from a squeeze. Pays a dividend, probably 3%, 2.9%. That might be one to watch, but again, it's got to get above the resistance from my perspective. Chevron, similar picture. Sucor Energy, nice little gap up on Friday, a couple of kahunas coming out of mobile breakout from a squeeze. Some earnings per share growth, pays a 2.9% dividend. Integrated oil refiner. I saw some strength in the refiners, but many of them, like this, have had beaten down charts. So I will go through the top 10 groups to see if I can find something that looks good. Oil services, this group got a bump when Halliburton put in a bid about 10 days ago for Baker Hughes. And I have a bunch of Halliburton, although I had puts on it because of when it broke through the 50 here. You can see it's got earnings per share growth, which is impressive. It pays a 1.2%, which is a nominal dividend. Its ROE is above 20, which I like to see. And it seems to have found a bottom. So I started adding to Halliburton and covering my puts last week on Wednesday. It has overhead supply. It's going to have a lot of regulatory issues. They may have to sell off assets. But when I put it all together, I see a company that's been a leader that trades at a smaller multiple than Schlumberger, that has pulled back hard down to almost a 200 weekly moving average. That looks to me like it may be putting in a bottom. As I said, I'm long it. Here's Baker Hughes. Obviously, the stock being acquired moves up. It's sitting at its 200. Schlumberger. So let's go back for a second. So Halliburton, after it announced its acquisition, it bounced a little bit. It gets a multiple of 13.5. When I go to Schlumberger, it gets a multiple of 18. 5 basis points on Halliburton is a huge difference when you look at your multiple. And in fact, Halliburton's projected earnings for 2014 are $4. So those 5 PE points are worth $20 in stock price. So a lot of the analysts have mentioned that they may see a better multiple. Now there's a lot of stocks that look like Weatherford. Great earnings per share growth, as you can see here. Definitely a bottoming-like formation. Trying to come back up. You can notice on-balance volume is already turned up. Mobile breakout from a squeeze on Friday right below the PSAR dot. I have a long position in Weatherford over the last couple of days. Does not pay a dividend. National Oil Varco trading up to its 50. Neighbors, very similar picture to Weatherford. Sold off hard, going sideways, putting in a base. Has fairly outstanding earnings per share growth. Pays a 1.4% dividend. Next group down, diversified banks. And I'm just going to point out the ones I know anything about. So let's just quickly look at Bank of America, JP Morgan, and Wells Fargo. So you can see a pocket pivot on Bank of America on Friday. On-balance volume is heading down, which I don't like. Mostly green up above. What I do like is they've got a big turnaround going in earnings per share. And when I look in MarketSmith, which I'm doing on my other computer to save time, they're projecting $1.49 in 2015 versus 47 cents in 2014. It trades at a multiple of 12. If it maintains its multiple of 12, it goes to $18. But with the expansion in earnings per share growth, it would not surprise me to see Bank of America increase its multiple, and its 5-year range of multiples is between 4 and 132. So you may have margin expansion in addition to big earnings coming in. I think you can buy Bank of America here with a stop below the 50. On the other hand, you could play the PSAR dot and put your buy stop above that and not take the trade unless you get that up move. I think this pullback to the 50 may have been a short-term bottom. Wells Fargo had a big move going sideways, traded into the PSAR dot with a gap up on Friday. Mobile breakout, you can see everything is green in a pocket pivot. On-balance volume is positive. Doesn't have the same earnings per share growth as Bank of America. And JP Morgan looks a lot like Wells Fargo, breaking above the 50, taking out its PSAR, but not the same earnings per share growth as Bank of America. So I think that group is interesting. Next group down, steel. I want to look at the steel mills, not the raw materials. Valley is another Brazil play. It's a Brazilian ore play. And like Petrobras, it had a big day on Friday. Not sure if this is a pan-Brazil thing, but you had a kahuna, on-balance volume went positive, you had a mobile breakout. Stock does not have any earnings per share growth. This entire market of ore and coal stocks have been under assault, pays a small dividend. It certainly would be looking for buying something off the bottom. Is this the bottom? A bottom, whether it's the bottom remains to be seen, but you're getting a good asset cheap, although not to say it couldn't be cheaper. Cliffs Natural Resources failed at the 50. I would not have any interest in this stock until it took out the 50. BHP Billiton, one of the big miners, similar pattern, failed at the 50. Needs to take out the 50 to become interesting. Rio Tinto, another of the big miners. Big miners, despite the short-term strength, look kind of lousy to me. Base metal index. This has got a couple of things I'd like to go through here. Copper is sort of a sign of prosperity of the country as a whole, and you can see it's been beaten back pretty hard, although it did gap up on Friday with a pocket pivot and a kahuna. On-balance volume showed positive convergence, green up above. So this might be one to start nibbling in with all the quantitative easing occurring, plus it pays a 4.2% dividend. I think I'm going to put that into my interesting stock list. Tech Resources, big gap up. This is an iron ore and coal stock. I've made a lot of money and lost money on this in the past. On-balance volume, preceded price move, had a kahuna, mobile breakout from a squeeze, everything turned green. 4.7 dividend. Something's going on here. Maybe it's all this QE that we're seeing outside the U.S. potentially worth going into as well. And then aluminum, Alcoa, looks like it's starting to break out. Don't be confused by the red spinning top day. It was a move up of almost 2% with a pocket pivot following a kahuna, mostly green from above, and it pays a 0.7% dividend, and it has great earnings per share growth. You could see here, fairly phenomenal. And lastly, in this group, Century Aluminum, ugly candle on Friday, traded up, closed at the open, sort of a shooting star. So I wouldn't buy this until I saw some price action that was supportive, coming out of a mobile breakout and a squeeze and a pocket pivot as well. Great earnings per share growth. Continuing down the list, semiconductor devices. Micron had a big move last week, up 5%. Its earnings per share growth clearly slowing down, but breaking out above the PSAR with a pocket pivot and a kahuna coming out of a squeeze. I like the chart pattern a lot. I'm a little, this is a stock that's had a huge run, and with the slowing earnings, I'm a little bit concerned. But if you look at a weekly chart, here's my favorite pattern: uptrend, sideways, breakout. So Micron is one that I added to, or picked up. Actually, I had calls, which I exercised and kept this week. Intel, inside bar day here on Friday, been a big mover of late. Nothing there. And Qualcomm. All right, what else do we got? Telecom carriers. All right, so this is another South American and Mexican play. I think there's also some acquisition opportunities. This is AMX, American Mobile. Nice day on Friday. Pocket pivot, kahuna, mobile breakout from a squeeze. It's still below the 50-day moving average. It does have some earnings coming into the stock. Pays 1.5%. Don't know much more about it. Level 3 communications. This has been one that off the March 2009 bottom has been just a phenomenal participant. In fact, I need to just take it to a monthly, because if I remember, this was low single digits. So March of 2009, we're talking about a stock that was $13, and it's now trading at 50. So one of the big movers off the bottom, a 400% return. Earnings per share is slowing down, but it's had a big move. Does not pay a dividend. Some of these carriers are attractive because of dividends. Here's an ADS that pays a 2.2%. Next group down is steel. I wanted to look at these. So let's look at, I want to look at Steel Dynamics, and I want to look at AK Steel, and I want to look at US Steel, and then I'm probably going to say goodnight. AK Steel, on a weekly chart, stock that it's been in a nice run, frankly, over the last year. Peaked at 11 in September, sold off 50%. US Steel peaked in September, sold off here. Let's look at the daily. Kind of going sideways. I like that a little bit more. Had a pocket pivot on Friday. OBV is negative. Don't like that. And then Steel Dynamics. Whoops, wrong one. Which has pretty phenomenal earnings per share growth. So let me check that by looking at daily graphs. And I've got a board meeting that starts in a minute, so I can be a couple minutes late. But I'm going to have to jump in a sec. So Steel Dynamics shows 210 in 2015 for 54% growth, $1.36 in 2014. It's at the 50. It took out the PSAR and had two kahunas in a row, a mobile breakout from a squeeze, and looks to me like this can be bought right here. So how do I use seasonality? Well, one thing I could see in 2000, this week, are the stocks on Friday that are setting up for good seasonality. And look at Steel Dynamics. So here's how I like to look at seasonality. Let me So Steel Dynamics has been in an uptrend over the last several weeks. It's at the bottom of the channel, and since I'm a channel trader at times, I'd rather be selling at the top and buying at the bottom. It gapped up on Friday, so it would have been a good day to buy on Friday. Now let me add some data to this. And I can see that if I buy November 25th through December 8th, it's up 9 out of 10 years, 9.7% average on the up years. If I look at the return for the next 5 days, 2%. So I have a stock that's in the midst of a 9 out of 10 uptrend with a 9.7% return, that's in the lower half of its range, already in an uptrend. I like this stock a lot. Also on the calendar, I could have gone down further or moved over here and show you U.S. Steel. And let's do the same thing about try and capture the last little bit of movement. Here's the range. So U.S. Steel is at the bottom of its range. And then these two green bars here represent very positive periods of time. And I could see 10 out of 10 from November 25th to December 8th. U.S. Steel is up for an average return of 12.9%. From December 11th to 24th, up 7 out of 10 for another 7%. So I've got really about a month of very positive time. The yellow line is the 5-year, is a 10-year. The green is a 5-year seasonality line predictor. And I've got an uptrend. So these are my linear regression channel going up. I'm within the channel at the bottom, coming out of a sort of a Morningstar pattern. Seasonality is in favor. And I'm going to go long either X or Steel Dynamics if the market is conducive tomorrow. On that note, let me just go back into the program and just point out before I say goodnight, there are other things that you can do besides what I did, which is what my approach to top-down investing, which is to get a sense of the market using multiple different tools. And then using HGSI, look for sector rotation, what's the leader in the market, and then go put together a shopping list of which we identified a number of things. I will at times look for stocks that have exhibited big volume. Not going to have a chance to go through them because I got my board call. I could also look through and look for stocks that are close to a reversal on the PSAR at a squeeze. So a lot of truckers showed up on my list. This is JB Hunt. And you should see a stock that's squeezing with the price right below the PSAR dot. And this is my favorite scan that I do every night looking for potential buys. And then I supplement it with a scan that I do in HGSI, which comes from a package from John Person. And it's his buy signal 2, and I run it on the market. And buy signal 2 are buy signals occurring at major support. And that, for me, is a great time to be buying. And so I build my watch list by the best of the HGSI scans. I use them from the John Person. And I like to point out in closing that here's Steel Dynamics using another analysis tool showing you've got a buy signal at support, which is this gold bar right here in Steel Dynamics on the daily. And at the same time, you also have a weekly buy that's in process. So I leave you on that note. I hope you all have a great week. Sorry for the quick finish, but I've got to do what I got to do. And just to remind you one more time, and to think about coming to our meeting. George and I would love to have you there. And we'll get some special guests that I've sent some invites to as well. And then just a shout out to Derek. Thank him for including his calendar function. Good night, everybody.